Well, hey there. This is Terry Sawchuk. It's Thursday, so it's time for 3-Minute Thursdays. I'm going to take a few minutes extra today because there's some things that are going on that I think are important, and I want to make sure that we cover some of the high-level developments that have taken place, not just in the markets, but some other revelations about the Fed. So let's start with what I think is going on in terms of some of the potential hotspots. The Japanese yen has been falling. The dollar has been strengthening against the Japanese yen. Actually, I'm going to pull this chart out for a while now. And what's interesting is that we hit a peak back here in October of last year, and then there was a immediate reversal, what it looked like a pretty significant intervention by the Japanese monetary authorities to get the yen strengthening back against the dollar. Then it didn't work and it started to climb back up again, got to exactly the same point, and then the intervention came in again, but not necessarily so effective. And what's interesting is within the last few days, we've broken well above that previous high, okay, which was around $151 or Japanese yen, 151.8 roughly to the US dollar. And now it's at 153.29. So this is a pretty significant development. In the past, this has led to an intervention because it really, when the Japanese yen starts to weaken too much, then they start importing a lot of inflation, and the cost of living can be very challenging. They've also let interest rates go up a little bit. Japan's been under something called yield curve control really since the mid to late 90s. And so there's been an interesting development in Japanese monetary policy, and we're not sure what the ramifications of this are going to look like yet, because every time we've gotten anywhere near this point in the past, it's been addressed. So that's something we're keeping our eye on. Earlier this week in the United States, and I'm going to go to the S&P 500 now, what we saw is the inflation report came in pretty hot. CPI came in well above most consensus expectations, and as a result, it created a pretty big drop in the market on Tuesday. Now, what was more interesting about that is that actually the drop in the market started late Monday night. Then when a report circulated that certain entities were gaining access to Fed data, these announcements, before they were actually announced. Turns out there's about 50 super traders, they called them, that were getting information from the Fed a day before or more. And it just goes to show you what I've kind of been saying for a while, that the system is rigged. I mean, it's rigged to benefit the big players. There's no two ways about it. Now, what's also interesting about how the market kind of played out is on that particular day, overnight, what you saw, and I'm going to switch this back to daily here. What you saw in the market on Tuesday was kind of a sell-off Monday night into Tuesday. The market opened down a lot, but then about halfway through the day, the market started to recover a little bit. And that is a symptom of what has been happening in the markets, where there are day-to-day options trading. They're called 0 days to expiry options. And they're designed to kind of compress volatility. And so you don't get these one-day kind of event-driven items or issues don't really spill over into anything else because of all the hedging that takes place. It really mitigates that volatility. And so, the good news is that it's created an environment where the market just keeps climbing, okay? The bad news is that one of these days when we get a shock that goes beyond where the hedges are, we could see a massive drop. Now, I don't think we're there yet, but it's something that we're keeping our eye on. Now, going back to the Fed, another interesting revelation that came out this week, and I think this is, it ties into why the market's doing what it's doing, and it ties into the political landscape. So there's a guy by the name of James O'Keefe, and he runs O'Keefe Media Group. He used to be with Project Veritas, but he got ousted out of his own company. And he's an investigative journalist, and he basically hires honeypots to infiltrate places where they get whistleblower information about things that aren't right. right? Whether it's illegal activities or immoral or unethical activities or, political things, all kinds of stuff. And in this particular case, he hired a woman to as a honeypot to go on a dating site and land a date with one of the high-level economists inside the Federal Reserve. And so what happens when they do this is they go out on a few dates, they start getting closer, and the target tends to get a little bit more comfortable. There's oftentimes alcohol involved, so they get a little loose-lipped in terms of what they're willing to talk about. And in this particular case, this bad economist said a few things that we probably assumed were true, but couldn't really prove it. But now that we've got right from the horse's mouth what's been going on, I think it just confirms what a lot of us thought. One, he said that there are literally zero conservative thinkers inside the Fed. They're all academics. There's not one conservative. They think conservatives are dumb, and they also hate Trump. And in particular, it's important because Powell hates Trump. And he went on to say in this 14-minute video, and this is just like clips of all the different conversations that he had with this particular woman, that they actually actively engaged in trying to undermine Trump's policies by creating Fed regulations that would counteract some of the things that Trump was trying to do in the economy. So you literally have a political, first of all, the Fed is supposed to be independent and completely apolitical. It's turned out that's absolutely not the case, and the evidence is pretty clear. But why that's important and germane to what we're discussing today, particularly about the S&P 500, is because it helps kind of explain why Powell's been talking about rate cuts at a time when inflation keeps running hot. I mean, we've got oil at $85 a barrel. You had a CPI report that came in way hotter than what anybody expected. And yet he continues to talk about policy being restrictive, which doesn't appear to be true, and that rate cuts would be in order, but maybe a little further out into the year. And the reason that he's doing this is because he and Yellen and everyone else that's in this group are doing whatever they can to keep the economy supported to avoid a recession so that it makes it more likely that Biden gets reelected in November. I mean, this is literally what this guy said in this video. And so it just gives you some insight into the apparatus, how essentially one-sided all of Washington, D.C. has become. And from an investment standpoint, the takeaway here is that, dips are probably to be bought. I mean, the reality is unless we get a significant exogenous event. Now, there's some things out there. Certainly if, the tensions between Iran and Israel continue to escalate, and let's say Iran, attacks Israel and the United States then somehow, quasi-supports Israel. I mean, that could escalate things, and the markets probably would not like that, and it could open the door to a more significant shock. We're certainly watching the Japanese yen, as I mentioned, because that has historically been a line that they've defended. And when they don't, the reason that they've defended it is because things can start to blow up in their financial system if the yen gets too weak. So we're watching that pretty closely. That has the potential to turn into something. Also in China, I mean, China's economy has been very weak, and they've had stimulative policies that don't seem to be reviving their economy yet. And, again, if China really starts to fall into a deeper recession, there will be implications because of all the debt that they have and the counterparties that are all over the world that might not get paid. Again, none of this is imminent, and I probably don't think that it's likely to manifest anytime soon. These are certainly things that could happen, but we're not planning on them happening. It's just we're watching them. Okay, so outside of things like that, the more likely scenario is we get a pullback here on a short-term basis. The ODT options minimize the volatility. The dips get bought. The Fed continues to be supportive. And if the markets really did take more of a deeper dip, I think it's reasonably safe, at least for right now, to assume that the Fed, meaning the Federal Reserve or even Treasury, could announce certain things that would be supportive and stabilizing and pave the way for the markets to continue to push higher. So that's our operating thesis right now. But I want you to understand kind of how we see the world and what's going on. Again, just some other things that we're looking at. I mean, oil has been on a pretty significant push higher. It's all the way back up to $85 a barrel, and it was as low as in the mid 60s just at the end of 2023. So, again, that's a perfect sign of inflation. Gold has been ripping, okay? Gold has been going up a lot, as you can see here. And gold is thought of as a hedge against inflation. And one of the bigger picture trends that appears to be happening is that other countries, their central banks and their governments are buying up physical gold. And they don't really care that gold doesn't pay a dividend. They don't care that it's not really an investment. They're developing, what appears to be, at least potentially, a different monetary based system that's going to at least be in part based on having gold as the backing. And so I think it explains some of the buying of gold and why gold's gone up. Will it continue at this torrid pace? It's hard to say. Technically, gold's overbought. So is it possible that you could get a correction? Absolutely. But because of the dynamics that are changing, it's hard to say. Gold could continue to rip higher, even though technically it's overbought. And so if it is true, the theories are accurate that these other central banks are accumulating gold aggressively, then that could push gold higher, and that's something that we're watching very closely. Silver is another area that we're looking at, and it's hit an important threshold here. There's a lot of shorts that are out there that we're trying to keep the price of silver down, and so why that's important is that we're looking at a potential short squeeze, and if that does happen, silver could go up quite a bit, and so we're watching that closely, and that may be something that we add to our portfolios. But we need to see, because it's right around this $25, $25.50 area where a lot of the activity in the shorting is taking place. And so we're not sure who's going to win that battle yet. But if we do get a squeeze, then silver could go up a lot, and we'll look to try to participate in that. So overall, we're trying to invest in areas that we think are inflation resistant, large cap equities, big companies that can weather recessions, that pay dividends, and that have a consistent track record of paying dividends are things that we're looking at. I think the S&P 500, Russell 2000 type strategies are likely to do okay as long as we don't get a major economic disruption. Other commodities, certainly gold, oil, energy, that's another interesting dynamic, and it's unusual. You don't normally see this where the dollar is strengthening and commodity prices are going up, and that is happening right now. And so that's kind of something that you don't really see very often, and it's not necessarily a great sign. And it could lead to an economic slowdown, because if commodity prices go up, including oil, right, while the dollar is strengthening, it creates problems for countries outside of the United States, because everything that they convert into U.S. dollars instantaneously gets more expensive. And on top of that, the commodities are more expensive. So you get a double whammy there. And that could slow the global economy down. And it could slow the United States economy down too, in the sense that once oil gets too expensive, all the inputs for everything, and it's not just oil, it's corn, it's other commodities. If these things keep going up and the dollar strengthens, it could pose some pretty significant economic headwinds. Again, nothing imminent, right? These are just the things that we're watching, and I'm pointing these out to you to show you that these are things that we pay attention to, and they're unusual, okay? So when something unusual happens, it gets our attention, and we gather the data, we look at the research, and then we make adjustments if we need to. So that's a high level, picture of where we're at. I know I covered a lot, way more than 3 minutes this week, but I hope that was helpful. I'll be back next week for 3 Minute Thursday, and I will definitely finish within 3 minutes. But for now, I appreciate you listening and look forward to our next chat.